There are several ways to look at housing to be able to determine the direction prices will go. We can simply look at the price index and follow the trend. That's what individuals, real estate agents, mortgage brokers, and financial analysts do. But there are hundreds of indicators to keep watching in order to be able to figure out what's actually happening and why. Well, that's why you came here for the truth, so let me unveil that for you. Today we're going to look at real estate in the United States specifically, but I will relate this to the rest of the world. I put way too much information into this video. I've got charts and articles, and just quite frankly, it's going to make your head spin. So let's get into it right away. I'll try to bring it to you as quick and concise as I possibly can. This article is out of Bloomberg. Housing market is raising serious red flags. Despite a robust U.S. economy, I disagree, at least as measured by the GDP, real home prices, their growth is locked in a cyclical downturn. I'm going to show you the factors on the charts to be able to determine exactly what's going on here. Essentially, what they're saying here is applicable to not just real estate, but any asset class. There are bonds and there are stocks and there is real estate and there is precious metals and other things that have cycles. And we can see them. They are, in fact, sometimes very short, sometimes longer. Depends on what you look at, and each one of these has measurements that we can take and put in place and decide this is a late part of the cycle, this is an early part of the cycle, and so on. Okay, we have the information available to us, and we don't just look at the current price. That's not a way to be able to determine a future price. Never ever is that a good way, and you just have to think for a second if that makes any sense. Yesterday it was $1, today it's $2. Therefore, every day it increases by $1. Is that sensical? Absolutely not. Absolutely not. You need to look at all factors that go in line with any one individual asset. You have to connect the assets together. It's connecting the puzzle pieces. That's what we do, connect the dots. U.S. leading home price index growth percentage terms. You'll see that this is in the negative territory. This comes out of ECRI. I've shown you this chart before, I believe. And we can see that there are other factors that are basically all in line with this. Less affordable. Housing affordability just fell to its lowest level in 10 years. That's the NAR Home Affordability Index. This is becoming too expensive. And why? Because the prices are rising. That's one factor. But the prices have really stagnated in a lot of these cities, yet it is still becoming too expensive, and that is simply because of interest rates. I'll get into interest rates more in just a second. I have a lot to cover today. Rough ride. Shares of home builders are among the worst performers in the U.S. stock market. This is the Bloomberg America's Home Builders Index. All throughout 2018, this has been dropping. It's not just because of the stock market. It's not just because of what we have seen throughout 2018 in emerging markets. No, we are seeing this for obvious reasons. It is very clear that the euphoria of the market is only existent in a couple cities around the United States, and it's just a few pockets of those cities too. Mortgage applications have declined to a level that was seen at the end of 2000, beginning of 2001. This should be shocking to anybody who's reading this, because when you see this type of data, you have to start to think, well, why is that the case? Are people buying without mortgages? Are they just paying in cash? Absolutely not. We do see that happening, but the majority of them are not being done like this. I mean, we have to be realistic. There is a slowdown that is going on right now. Ever since the financial crisis, people have not been able to get what they wanted to previously, and that goes for many factors. I'm not just talking about real estate, but you'll see that, and the way that they've been buying homes today is more and more reliant on some sort of scheme, whether it is, all of the different mortgages that are available. They have personal loans, they have home equity line of credits. They are financing all of this madness with debt. And you cannot do that forever. That's why these cycles are so violent. If things were not so erratic and irrational, then the cycles would barely be existent. If I just grab my pen here, because the way we have it today, it's like a sine wave, right? Everything moves in a sine wave. And this is a normal pattern of any particular asset. If I put a line through it, it goes from overvalued to undervalued, okay? Overvalued to undervalued, constantly. This is what happens with any asset. And then it's difficult to determine where are we in that particular cycle. Some people gauge it, some people don't. A lot of people are actually, let's say, past the peak and still believe that there is going to be another leg up. Nobody really knows until we look at it in the pages of history. But anyway, the point I was getting at was that if we had real markets, it would be more like this. And you would see more of a flat kind of line with bumps along the way. But the bumps are nice and easy. They're not aggressive. They're not going to really make a huge impact on all of a sudden millions of people. That's not the way it works. But here we have central banking. We have the madness you see today. So this is a couple charts in a row. Number one, housing permits, single and multifamily. You can see here what has happened, that it has grown all throughout, since the period after the financial crisis up until today. But now we're seeing either a stagnation or a decline. And that has really happened. And one of the things I want to tell you is housing permits is very important. Keep your eyes on it. Keep your eyes on it for sure. Housing starts, single and multifamily, the same situation, either coming down or stagnating. Looking at this, housing starts year over year change. That's another way to look at it. This has been coming down for years, all right? And then we look at the 30-year mortgage rate. Now, this is one I always keep an eye on. Almost every single day, I'm looking at what interest rates are doing. The 30-year rate is currently sitting at 5.1. This level has not been seen since back in 2011, and soon we're going to get to the levels from 2010, and then give it some time, won't take long, we'll be back into the 2009 level, because it's going to escalate to 6% in no time at all. All right, maybe in 2019, in the first part of the year, we may see that. We may see it going towards 6%, and it goes faster and faster and faster. Okay, it really does escalate in a short period of time when there's panic, when there is a concern, whether it's they are going to taper at a more rapid rate, whether they're going to increase interest rates and continue to do so, which they're very fearful of right now. We don't know what's going to happen, but I can tell you right now, it usually happens faster than we can predict. Looking at this, I'm going to cover this very, very quickly and go through talking about San Francisco in particular, but other cities as well. The increasingly common sight of vacant buildings and empty storefronts around San Francisco, despite the thriving economy, has local business owners and city officials pushing for change. It has become so expensive to get retail, and a lot of businesses are just saying, forget it. I'm not going to buy this because this has been, just I can't keep up. I can't sell enough in order to be able to keep this place running. I can't keep the lights on. The laws of supply and demand work everywhere except for San Francisco retail space. There is nothing that is there to push them into renting the spaces. And you see what happens. They have their vacancies that have been rising. Why? Because the thing is too damn expensive and they don't care. They don't want to be able to bring the price to a reasonable level. California exodus. Poll finds voters consider moving due to sky-high housing costs. This shouldn't surprise anybody. I've shown you the videos before that are jam-packed with the data showing a lot of people are leaving the city, leaving California as well because they're in search of other places. Maybe it's Arizona, maybe it's Florida, who knows? There are other places that I showed you that they're seeking better opportunities. They want cheaper housing, maybe they want jobs, maybe they want something that isn't available to them in California or simply become too expensive. The taxation is much higher generally in California than a lot of the other states, so they're going elsewhere. But it's particularly evident in an area like San Francisco. All right. I am getting fed up. A Bay Area landlord is leaving California and taking his tenants. A San Jose landlord is packing it up and heading east, it being his belongings and a majority of his tenants. All right, so that's just another example there, and they get into the details of that. Sacramento seeing influx of people from pricey coastal cities. A lot of these places, they're very expensive when you look at rents, when you look at retail locations and everything else that's interconnected, because hey, if you're in a location that's very expensive for your rent, you have to charge your tenants a higher price. That means the customers, perhaps if it's retail, customers got to pay more. Might be the same exact thing, but location, got to charge you more. That's the way it goes. Or else there's vacancies. And if you can't find, customers to come in because your prices are higher, you leave, you have a vacancy. And that's the way this works. I've seen it many, many times before. That's just the way it is. Prices are too high. No businesses can go in there. And then they'd rather leave them empty. It's ridiculous, but that's just the way it goes. Okay, so that's that for Sacramento. There's actually a website, leavingthebayarea.com. This is real. Real estate solutions for your next life move. You can get a free consultation from this website. You can scroll through here, how we work for you. You go through this, you tell them where you want to go, and they're making it because of why? Because there's one or two people that want to leave San Francisco? No, because there's a lot of people that want to get out of there and need to get out of there because it's too expensive. So an actual service has popped up making this available for a lot of people. Now you could do this obviously on your own, but this is a service that they're providing. They know what's going on. They're getting clients all the time. I'm sure they're not the only one, but that's just one that I happen to find. Now, this comes out of the Financial Times. Could Manhattan be on the edge of a prime housing precipice? Even as developers have been reshaping Manhattan's skyline with soaring residential towers, the local new build market has been dropping like a stone. Talk to people that are in New York today, and you'll find that the market has truly hit a peak. They are unable to sell homes. It's becoming very difficult, but hey, they're too expensive. If they were cheaper, I'm sure people would be buying, people would be selling. But it's not happening because the prices are so unbelievably high. The number of new homes sold in Manhattan in the year to September is down 39% on the same period in 2017. Now, if you don't tell me that's a slowdown, I don't know what's going on. We're on a different planet. Right here, they're saying this local property appraiser, we're in the middle of a U.S. housing slowdown. Manhattan's prime market, the first and most sensitive to react. That's what they're saying. I agree in this case here, but hey, if they bring interest rates down, if mortgage rates come down, maybe things can change. High-end property reshapes Manhattan's skyline. If you're interested in looking at this out of the Financial Times, they're just showing you all these towers that are coming up here. Literally multi-million-dollar properties. And what do you get? You get a box in the sky. That's it. Multi-million-dollars. All right. And people will buy these. It wouldn't surprise me to see the very, very top end luxury market still do well because the top end has been doing better than ever before. All right. And then last but not least, very quickly, risky lending to the UK companies has increased. Although this is talking about the UK, I wanted to connect this in with the general issue that we see, and that is the fact that more and more money is being given to individuals who shouldn't get it in the first place. These are people who didn't pay their bills, and now they're getting all of these different loans, whether it's real estate or whether it's personal loans, line of credits, and so on. Eventually, this comes to bite them in the behind. People are taking on too much debt. And it's not, in many cases, it's not because, they want a new iPhone. A lot of times, they're taking out loans because they need some money now. All right, now I don't know what they did in their past. I don't know what's going on, but you can't blame every single person for their financial troubles. Sometimes It happens, okay? But it is your responsibility to get out of that, and we have to do what we can to get out of the situation, because debt is the system of control of the bankers, and we can fight against it, and all we have to do is get away from their system as much as we possibly can. It takes a lot of effort, and certainly maybe it's difficult to be 100% out of it, but if we make those steps, if we take the right steps and make those choices, we will do our very best. I know that's going to make a difference in everybody's lives. All right. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps us support this channel. So I do appreciate that very much. And last but not least, if you want the financial education you were not taught in schools, these 2 books have it all. I talk about real estate in both of these books, the importance of investments, what to do, everything from the foundation, the history, and everything. You get to know all the information you need. Check them out. Links in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.